Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Charter Market Technician and Portfolio Manager. Thank you so much for joining us this week. We got a couple of topics. We're going to talk about consumer sentiment, one of the economic news to drop last week, and kind of break down into that. And then Andrew's going to drill into new highs and new lows, really an important metric to be looking at as we have the S&P 500 hovering in the vicinity of near-time highs. Always important to look at the underlying stocks within that index and even broader. So we'll dive right into consumer sentiment. I would say uh, data like this takes an elevated level of importance when we've had a government shutdown for so long. We've had so many weeks without critical data that we would otherwise get for especially the labor market. So anytime you have another piece that comes out from a private issue, in this case, the University of Michigan, with the consumer sentiment, it's going to make bigger waves. That's one point I would make about the data I saw last week. The other is what you see in the chart, which is a breakdown of consumer sentiment by those that own a lot of stocks versus those that don't. And if you think about it, it can be somewhat of a dumb moment, but you can see it break down into the chart to really some significant levels. And really, just the overall background over the past couple of years has been a strong divergence really between consumer sentiment and the overall economy. We've seen weaker sentiment overall, even though we've had a fairly decent economy over the past couple of years. And that was true during parts of Trump, during parts of Biden. You can break it down both ways. But one thing is clear those that hold a large amount of stocks, the top line or the blue line in this chart, have been having higher levels of sentiment, which makes sense with a rising stock market. Meanwhile, those that don't own stocks at all actually have sentiment that's worse than where it was in 2022. So even though we had, a mini recession scare at that point in time, that particular cohort actually feels worse about their circumstances than when they were back then, which again can make sense. The fact that we had a big spike in inflation, and even though the inflation rates have moderated, that's really continues month after month to be the sticking point for that cohort. So increasingly, the economy, we could say, is tied to how these biggest shareholders move on. The last little grain of salt, or the extra wild card I would put in there, is that this group also has a lot of income coming from their cash holdings. So to what degree income adjustments from reduced interest rates play into this will also be a factor into that cohort. So that's a consumer sentiment. I'll pass it over to Andrew to take a look under the hood at the stocks.
All right, thank you, Adam. So this was a topic that I just got done filming a really long podcast for an industry podcast because there's such a heavy topic right now within portfolio managers and those that are watching the market of kind of what's going on below the hood of the market. And so the way I described it there, and I think is really important as we discuss kind of separating the performance of an index and looking at how individual stocks are performing, is that when we start seeing some troublesome signs as we are right now, in the breadth data, the data we're going to discuss right now, it doesn't necessarily mean that it's a signal that the market's going to respond. We liken this to when we start seeing the clouds begin to darken in the sky. It doesn't tell us that it's going to rain or that we're going to have a tornado. It simply tells us that the conditions are there for one to form. And then we want to start looking for actual signs of those funnels or actual signs of the clouds breaking and rain start forming. But what we're seeing right now is a little bit troublesome from a clouds forming perspective. And what that is where we're sitting with the market just off all time highs. When we look at how individual stocks are performing, we actually are seeing more new lows, stocks hitting the lowest level of the last year, than we are seeing stocks hitting the highest level in the last year. If we zoom in on this chart, there's a lot going on, and let me unpack it for you. On the top, we have the simply each day the number of stocks that are hitting new highs. Then in the red, we have the same number. How many stocks are hitting new lows in the S&P 500? And what I want to focus on is that bottom panel. You'll see there's big gaps there. This is looking at the data only when the market is within 1% of making a new 52-week high, telling us that, okay, how strong is the market when we're seeing new highs? What's concerning, if we look at the far right, you see it says negative 17, meaning when the market was less than 1% away from its high last week, we actually had 17 more stocks making new lows than new highs. And this was a significant number. The last time we saw a large number like this was actually in October of 2018. And then we have to go all the way back to 1999, the last time it was actually 17 then as well, to when we started seeing the market just off its high, but we're seeing a significant number of new lows. Now, this is telling us that we're starting to see a little bit of a breakdown, but the fact is the stocks that are leading the market, the ones that are the heaviest, the largest weighting, those Mag 7 that we often talk about in the market carver, continue to show fairly relative good, strong performance. And that's what's really carrying the market. But when we start seeing this fracturing, when we start seeing more new lows, is when we do have historically started seeing a breakdown and we start seeing the market get a little weaker. We look at the next chart, looks at a similar type of data. Again, this was looking at when we see it between 10 to 15% of stocks are making new highs, but over 10% are also making new lows, and we get these red arrows. And when we see historically, it becomes kind of a coin flip over the next 6 months to 1 year, where the market's up 8 times out of the 16 and it's been down 8 times out of the 16. A much less bullish outcome than traditionally we do see in the market often is higher much more than just 50% of the time, and this has preceded some fairly significant market downturns. Now, there's also times if we were to zoom in on each one of these instances where the market was able to shrug it off. We saw stocks began to pick up their performance. We started seeing those new high lists begin to expand, and the trend continued higher. And so that's why we always want to be really cognizant of what the actual index is doing as well. It right at this point hasn't been much of a concern for the major indices, and it may not be in the future, but it's something we want to recognize. We want to see that the clouds kind of are getting a little dark. Maybe it will be nothing, and we'll have brighter skies in weeks to come. But we are seeing a significant number of stocks that are kind of breaking away from the market trend, and we always want to be wary of what individual stocks are doing as well as what the individual index is doing.
Thank you, Andrew, and very well put. And always, a lot of science and stats and hard data behind something that just observationally, having been in this and watching the markets day in day out for almost 25 years at this point professionally. You know, just looking at those charts day to day, it really has stuck out these last few weeks, and it's been a unique environment. And so really putting color on this. I'd say the best outcome we could hope for is that we see a lot of these stocks join in. That would be the best outcome. But I want all of you listening to know that we're really ultra tuned and really have our antennas up, in case that the outcome is the other way, and the broader market. And the stocks that lead those tend to join, the large numbers that have went the other way. So we are more tuned into that than I would say per usual. So uh, and as always, we stand vigilant and we'll follow our process and make adjustments as necessary. So thank you so much for your time. If we can be of service, please don't hesitate to give us a call, 800-928-4001, or scan the QR code and do so electronically. Thanks and have a great weekend.